The markets had a volatile session today, May 4, 2026, as geopolitical tensions in the Middle East, specifically surrounding the Strait of Hormuz, jolted investors and sent oil prices surging. While the major indices pulled back from their recent all-time highs, the drop was somewhat cushioned by ongoing strength in the tech sector and a solid earnings season. SPY market performance. The SPY, SPDRS, and P500 ETF Trust closed down roughly 0.37% at $717.95. Intraday action. It was a choppy day for the ETF, which opened near $720.09 and hit a high of $722.12 before sliding to a low of $715.01 during the midday volatility. Trading volume was steady at approximately 7 million shares by late afternoon. Key levels. The market remains near its 52-week high, $724.87, showing significant resilience despite the macro headwinds. Major market news. 1. Geopolitical tensions and oil surge. The primary driver today was the escalating conflict between the U.S. and Iran. Reports of a purported strike on a U.S. Navy vessel, which the U.S. military later dismissed, caused Brent crude to leap over 5% toward $114 per barrel. The closure of the Strait of Hormuz remains a major inflation specter for traders, as it restricts global supply. 2. Earnings season continues. Despite the red on the screen for the indices, corporate earnings remain a pillar of support. Tyson Foods, TSN, beat expectations on both profit and revenue, closing up nearly 4% as higher meat prices offset lower volumes. Norwegian Cruise Line, NCLH, tumbled about 9% despite a profit beat, as investors worried about rising fuel costs and war-related travel impacts in Europe. Palantir, PLTR, released results today, Monday, with investors closely watching for AI-driven growth metrics. 3. The GameStop/eBay shocker. In a move that caught many off guard, GameStop, GME, disclosed a 5% stake in eBay, eBay, and launched an unsolicited $56 billion bid, 125 share, to acquire the e-commerce giant. eBay shares jumped over 5%, while GameStop shares fell nearly 8%, as the market weighed the feasibility of the massive cash and stock proposal. 4. Tech and AI resilience. AI-related names continues to lead the pack. Micron, MU, gained over 6%, while Oracle, ORCL, and SanDisk both saw gains of roughly 5%, helping the Nasdaq stay relatively flat compared to the steeper drop in the Dow. Looking ahead, the rest of the week is packed with binary events that could either cement the current buy-the-dip mentality or trigger a deeper test of the 200-day moving average. Here is the breakdown of the high-impact catalysts for the SPY and the broader economy through Friday. 1. The macro and geopolitical wildcards. The dominant story remains Project Freedom, the U.S. initiative to escort cargo ships through the Strait of Hormuz. Energy prices. If the escort mission successfully lowers the risk premium on crude, look for a relief rally in the SPY as transportation and manufacturing costs stabilize. However, any further military friction in the strait could send oil toward $120, which analysts warn is the breaking point for current market valuations. The VIX. Currently, a sustained move above 25 is being cited by strategists as a signal that the market has shifted from buy the dip to sell the rip. 2. Critical economic data. We have several Tier 1 inch reports that will dictate the Fed's next move. Tuesday, May 5th, 8:30 a.m., U.S. international trade in goods and services. This will provide insight into how global shipping disruptions are actually impacting the trade deficit. Thursday, May 7th, 10 a.m., construction spending. This is a key report for the industrial sector. A beat here would support the marathon broadening theory, where the rally moves beyond just tech into cyclicals. Friday, May 8th, the April jobs report. This is the big one. Markets are watching the unemployment rate closely. If it ticks above 4.5%, the soft landing narrative will be under heavy fire. 3. The Fed's quiet influence. While there isn't a formal rate decision this week, several Fed officials are hitting the podium. Tuesday, May 5th, Vice Chair Michelle Bowman speaks at the Women in Housing and Finance Symposium. Friday, May 8th, a heavy day of rhetoric with Governor Lisa Cook speaking on tokenization/digital assets, Governor Christopher Waller, and Vice Chair Michelle Bowman participating in policy panels. Expect them to address whether the oil surge is seen as a transitory supply shock or a long-term inflation threat. 4. Key technical levels for SPY. Traders are zeroing in on these specific zones for the remainder of the week. Resistance, 720 minus 730. This is the immediate upside target, fib extensions. Breaking and holding $725 would likely signal a run toward new all-time highs. Support. Initial support sits at 688, with the major floor being the 200 minutes-day moving average AT665. Earnings watch. May 5 to 8, Tuesday. Lifetime, LTH. Reports before the bell. Wednesday. Look for the New York Fed's research release on gasoline spending patterns. While not an earnings report, this data will be a proxy for consumer health in a high oil environment. Ongoing tech adopters. Capital is reportedly flowing out of hardware, NVDA, and into AI adopters in logistics and finance. Keep an eye on sector rotation within your scanners to see if the SPY's tech component remains top-heavy or starts to diversify. As of today, May 4, 2026, the market is displaying a fascinating tug-of-war. Technical greed is clashing with a sharp spike in real-time anxiety. 1. The VIX, the fear gauge. The VIX is currently trading at 18.29, up roughly 7.6% today. The surge. After closing at 16.99 last Friday, the index gapped up at the open and hit an intraday high of 19.08 during the heat of the midday Middle East headlines. Context. While an 18 to 19 reading isn't panic territory, which usually starts above 25 to 30, it is a significant shift from the complacency zone sub-15 we saw earlier this year. Hedging versus panic. Analysts are currently characterizing this move as hedging demand rather than a total liquidation. Big players are buying protection puts due to the Hormuz situation, which is bidding up the VIX even while the SPY remains relatively near its highs. 2. CNN Fear and Greed Index. Despite the VIX spike, the Fear and Greed Index is still pinned in greed territory with a reading of 65. The disconnect. This seems counterintuitive given today's red screen, but the index is a slow-moving composite. It's still being propped up by stock price strength. The S&P 500 is still trading well above its 125-day moving average. Market momentum. Up until this week, the trend has been relentlessly bullish. The trend. Just 2 weeks ago, this index was at 70. We are seeing a slow cooling off from the greed zone, but we haven't hit neutral, around 50 yet. 3. Crypto fear and greed. Contrast. For a broader look at risk sentiment, the Crypto Fear and Greed Index is much more pessimistic, currently sitting at 39, fear. This suggests that risk-on speculative assets are feeling the macro pressure much more acutely than the blue-chip stocks held in the SPY. The bottom line, we are in a greedy but guarded phase. The VIX rising while the Fear and Greed Index stays high often indicates a correction in the works. Investors are still holding their long positions, greed, but they are becoming increasingly expensive to protect, rising VIX. Right now, the tape is screaming day traders market, though there is a compelling case for aggressive swing trading if you have the stomach for gap risk. Here is how the current environment breaks down for each style. 1. Day trading, the current king. This is arguably the best environment for intraday players. Volatility/ATR. With the VIX pushing toward 19 and the SPY seeing 5-7 intraday swings, there is more than enough meat on the bone to hit profit targets before the 4 p.m. bell. Opening range opportunities. Because the news cycle, Middle East oil, GME eBay, is so heavy, we are seeing significant gap and go or gap and trap price action. The first 30 to 60 minutes are providing high probability setups that don't require holding overnight. Risk mitigation. By flattening your book at the end of the day, you eliminate the overnight headline risk regarding the Strait of Hormuz or surprise pre-market earnings. 2. Swing trading. High risk / high reward. It's a difficult market for traditional swing trading because technical levels are being violated by macro news rather than price discovery. The gap problem. You might have a perfect technical setup on a daily chart, but a single headline about oil supply can cause a 2% gap against you at the next morning's open, blowing past your stop loss. The strategy. If you are swinging, you almost have to trade smaller position sizes and use wider stops, or use option spreads to define your max risk. 3. Investment market. The wait-and-see phase. For long-term investors, this is a period of observation, not necessarily heavy accumulation. Valuation concerns. With the SPY still near all-time highs and the Fear and Greed Index at 65, you aren't exactly buying the blood. The entry zone. Most long-term value buyers are waiting for a true test of the 200-day moving average, around $665, or a move into extreme fear, below 25 on the Fear and Greed Index, before adding significant capital. Summary table. Style, rating. Why? Day trading. Optimal. High intraday ATR and clear morning trends. Zero overnight risk. Swing trading. Caution. High headline risk. Gaps can bypass stop losses overnight. Investing. Hold. Markets are still extended. Better entry points likely if VIX stays elevated.